Good morning and welcome to the Business Standard Morning Show. I'm Debarghe Sanyal and here are the top stories for the day. After 2 years in the fast lane, India's passenger vehicle consumption may be finally running out of gas. As the number of outstanding orders increase and footfalls fade at auto dealerships, are car sales moving to the slow lane? We decided to check the fuel gauge on auto sales. Is India's passenger vehicle or PV market finally hitting the brakes? Dealers admit that there has been a slowdown in footfalls and fresh inquiries since January this year. Those who Business Standard spoke to said showrooms have seen an 8 to 10% fall in footfalls compared to the same period last year. Meanwhile, there are around 7 to 8 lakh outstanding orders in the market.
We do not vouch that 8 lakh would be 100% genuine bookings, because a lot of customers would have overlap bookings also in multi-models, multi-dealership and different variants. So we can comfortably park those kind of customers to between 15 to 20% of the total bookings, declared bookings. We always pitch for 15 days freedom. But in March, as you see, there are a lot of festival days coming in. We are just about to see the Navratri starting in. So normally what happens during the festival time, dealers tend to accumulate stock so that they will be able to liquidate in these last 10 days of March.
The softening trend comes as the pent-up demand which boosted sales in the last 2 years is dissipating with normalization of production. Last year, the auto industry posted its highest ever annual domestic sales at nearly 4 million units. This was on the back of pent-up demand and better semiconductor chip supply. The figure was 23% more than that of 2021. But how does one reconcile that with the pending order book?
We have a tale of two cities here. So on one hand, we have some models where we have a good supply position. There, the pending bookings are not very large. And then there are some models where you have a supply constraint. There, we have a long waiting list. And that is why both statements seem to be correct.
Inventory of unsold cars with dealers have also reportedly touched a 4-year high, even as the pace of fresh bookings start to slow down. According to industry estimates, unsold stock among car dealers is likely to reach around 300,000 units, which is worth $2.5 billion by the end of March 2023. This will be the highest figure since September 2019.
I think the inventory largely is made up of those models where production is high and there are very few pending bookings. There are some models where the production is less and therefore very little inventory is available. That is the story also of other OEMs in the industry as well.
OEMs should also manage their production line so that even their slow moving or average moving models or vehicles which are available in X stock, that should be of a 15 days paid up stock only available at the dealership, so that we don't create a situation like 2017-18 where every dealer was struggling and the paid up stock had gone up to 60 days.
However, both original equipment manufacturers and car dealers agree that easing of taxes and interest rates on car loans will help counter the slowing trends.
Factors which we have to watch out for is the interest rates regarding auto loans, which have gone up in response to the repo rates which have been increased, and the consistent and the very sticky inflation that we see. which might affect the overall liquidity in the system.
We are not projecting in any ways now a double-digit growth in the coming financial year. What we are quoting is a single-digit growth for the PV industry in the coming financial year. We have been strongly advocating that it's the high time and right time to reduce the GST of passenger cars, of entry-level passenger cars from 28% to 18%. In fact, for two-wheelers also.
Auto dealers also point out that the last 10 days of March are crucial and demand often picks up around festivals such as the Navratris. Till then, they think it is prudent to wait and watch. The Bar Council of India, or BCI, has allowed foreign lawyers and legal firms to practice in India. A fresh notification from the BCI dated 13th March says foreign lawyers can offer legal advice to clients on foreign laws and work on corporate transactions in India. So, what does the new rule mean to the Indian legal landscape? Tariq Ahmed looks for the answers.
After prolonged disapprovals, the Bar Council of India, or the BCI, has finally allowed foreign lawyers and law firms to practice in India. Now, foreign law firms and lawyers can open their offices in India and offer legal services on international laws and arbitration matters for foreign clients in the country. This approval follows the principle of reciprocity in a well-defined, regulated, and controlled manner. However, the rules restrict foreign lawyers to appear before any Indian courts, tribunals, or statutory or regulatory authorities. The foreign lawyers will be allowed to extend corporate services such as joint ventures, mergers and acquisitions, intellectual property matters, drafting of contracts, and other such works if their country reciprocates the same. This means the country of the foreign lawyers should allow their Indian counterparts to offer the same kind of services in their country.
If you take Australia, for example, under the Australian Free Trade Agreement, certain skills have reciprocal recognition. So it can well be that they will grant a right of practice to Indian law firms in Australia in exchange for that same right over here. Now the Bar Council is no longer an impediment to that. In fact, the Bar Council has laid out a pathway saying, yes, Mr. Australian law firm, you want to practice in India. These are the 12 documents I need. This is what you need to show, and please come and practice over here. So all these things will change, and they're all for the good. And I say good generally because change in status quo is always good.
Previously, foreign lawyers were allowed to practice in India on a fly-in and fly-out basis. This means a foreign lawyer would provide services to Indian clients without registering with the BCI if the period of service is not more than 60 days in a year. Under the new rule, the same provision will continue and the reciprocity clause will not be applicable in this case. If the service exceeds the time limit and if the law firm has to establish an office in India, it has to register with the BCI. The Bar Council of India expects the move would prove beneficial for the legal profession in India. In its notification, the BCI expressed the hope that the new rule will make India an international arbitration hub. It will also help the country to address issues related to foreign direct investments in the country. So, what changes does the new rule bring to the Indian legal landscape?
I think that there will be a healthy competition for larger law firms in India. Which can also be a very positive thing. It can give, opportunities to learn, to imbibe the best of other, legal systems, healthy collaboration. So I think that's the positive that will come out of it. The second important positive for a lot of advocates who are qualified in dual systems, there will be a huge advantage for those type of people. So there are many advocates who are qualified in India as well as some foreign jurisdiction. So those advocates will now have the opportunity to either partner with or be associated with a foreign law firm.
The BCI's move to allow foreign lawyers may bring a change in the existing fee structure for legal services in the country.
As far as the corporate clients are concerned, over a period of time, it could result in an increase in fees being charged to them. Certainly not immediately. At the moment, both foreign clients and Indian clients are very, very cost conscious when it comes to legal fees. So I don't think at the moment there will be any big drastic change in this.
The other aspect here is to look at how the Indian clients will respond to foreign legal services.
What did the Indian clients want? Do they want that kind of service? And I raise this point because I've always seen markets which have opened up to foreign lawyers are markets where the clients insisted on it. While the Bar Council notification does talk about clients, in reality, common law English speaking lawyers are available in India. We have been working, we have been appearing against, side by side, in tandem with the best law firms in the world. So suddenly, has this buyer of legal services in India changed its mind and said, no, by the way, I'm using so-and-so law firms in India, but they're really no good. I want an international law firm. That is something that time will tell.
The approval for foreign legal firms to practice in the country is likely to give India's international trade and flow of foreign direct investment a fillip. Experts believe the ensuing competition between Indian and foreign legal firms will be beneficial for the legal landscape of the country, as it can bring out the best practices in the field. It will also open up new opportunities for Indian lawyers. But how Indian clients are going to react to the new situation remains to be seen.
The recent banking turmoil in the West has prompted a sharp fall in crude oil prices, which have tumbled over 18% so far in 2023. So, will the commodity continue its decline? And should you add oil-related stocks to your portfolio? Our next report helps you decide.
Oil prices have remained soft for the last 9 months on fears of a global slowdown. The recent crisis in the global banking sector has sharply accelerated the oil slide on fears of a squeeze in demand. Prices of Brent crude and WTI crude have dropped to 15-month lows below $75 per barrel and $70 per barrel. In the near term, analysts believe that crude oil prices could recover due to firm Chinese demand and planned production cuts by OPEC+. However, a sustained uptrend still depends on improvement in the global growth outlook.
With recovery in demand from China, a shortage on the Russian oil and a planned production cut from the OPEC could offer some respite to the prices, and we are eyeing $64 in Brent and $61 in WTI to act as a key support to further cap the damage. And for a short-term reversal, we need a decisive close above $90 in Brent and $83 in WTI. However, for a sustained recovery, the key factor would be the improvement in the global economic outlook in the coming months.
Meanwhile, despite the fall in crude prices, analysts believe that oil marketing companies or OMCs still remain a few quarters away from recouping the losses on their marketing margins. Those at JM Financial say that optimism for OMCs is contingent on crude sustaining below $75 to $80 per BBL and government compensation. The brokerage has buy ratings on HPCL and BPCL given their attractive valuations and a hold rating on Indian oil. That apart, experts say that the reduction in windfall tax on locally produced crude oil will likely benefit both oil producers and standalone refiners.
We expect the outlook for the three OMCs to be weaker than the previous year in terms of profitability. Even if the oil prices have now come down, these companies incurred heavy marketing losses in first half, which will bring down the overall earnings for 2023. For upstream companies, sustained higher crude oil prices and gas prices can result in better profitability for the upstream companies. We expect the companies to invest heavily in capex for their continuing efforts to expand production. Our two stock picks from this space are ONGC and Oil India.
On the bourses, barring Reliance Industries, shares of BPCL, HPCL, Indian Oil Corporation and Chennai Petroleum have surged up to 18% so far this year. In comparison, the BSE Sensex has declined 5% during this period. As regard today, all eyes will be on the US Federal Reserve's interest rate decision. In view of the banking crisis, market participants remain divided over the likely quantum of rate hike that the central bank could deliver today.
the Silicon Valley Bank in the US defaulted this month, Switzerland's second largest bank, Credit Suisse, was facing a similar situation. But the Swiss regulators intervened just in time to avoid the collapse. This intervention was necessary to mitigate the risks of a global banking panic situation, as Credit Suisse was listed under the Global Systemically Important Bank, or G-SIB. If you're wondering what a G-SIB is, we decode it for you in this segment.
The Financial Stability Board, or FSB, is an international body that monitors and makes recommendations about the global financial system. FSB, together with several national and international authorities, has listed 30 banks as globally systemically important. This means that these banks are too big to fail, and the default of any of these banks can lead to an economic crisis. Owing to the threat that the failure of G-SIBs poses, regulators have stringent measures towards these banks. G-SIBs have higher capital requirements and supervisory expectations. G-SIBs have to fulfill the total loss-absorbing capacity standards and have to conduct regular resolvability assessment in order to avoid defaulting. JP Morgan Chase, HSBC, Deutsche Bank, Goldman Sachs, UBS and Credit Suisse, amongst others, are some banks that are listed as G-SIBs by the FSB. Based on the capital requirements, FSB has classified the G-SIBs into 5 categories called buckets. Basel Convention of Banking Supervision, or BCBS, monitors the bank's performances each year. For that, the BCBS uses 14 denominators across 5 categories. BCBS determines the score of each listed bank every year, and according to the score, banks can move to a lower or higher bucket. 13 of the G-SIBs are from Europe. There are 10 banks from North America and 7 from Asia in the list. Africa, South America, and Oceania don't have any banks listed as G-SIBs. Also, there are no Indian banks in the list. Each country has its own list of domestic systemically important banks, or DSIBs. For example, the RBI has listed HDFC Bank, State Bank of India, and ICICI Bank as DSIBs in India. In the case of Credit Suisse, as it comes under the GSIB list, timely intervention was necessary. The GSIBs are deeply integrated into the global financial system, and it is related to several other banks and financial institutions. The failure of such a bank can cause serious threats to the whole equation. In this case, Switzerland's financial regulator FINMA intervened and ensured that UBS took over Credit Suisse. The deal was done in a matter of days.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The 2 US banks that failed, SVB Bank and Signature Bank, were not classified as G-SIBs. That's all for today. For more news and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.